So you've either got yourself a Vanguard Stocks and Shares ISA or you're just about to get one for the very first time. In this video, I'll go through the top 6 mistakes that beginners tend to make when investing in a brand new Stocks and Shares ISA across Vanguard, Fidelity and loads of the other platforms that we have available in the UK to invest your money into. Investing is both scary and exciting at the same time. I've been doing it since I was about 19 years old, so almost 10 years now, and it has been an awesome experience. I've made loads of gains in the stock market and made tens of thousands of pounds. In the beginning, when you're a new investor and understanding how funds and platforms work and seeing Vanguard for the first time, it can be very confusing, daunting and overwhelming, but I assure you it's very simple, it's very easy, and there are a few easy mistakes that you can avoid by checking them out in this video. So let's jump in. Firstly is investing before you are ready. Now, the legal age to start investing in a Stocks and Shares ISA in the UK at the moment is 18 years old. Now, I would highly recommend anybody on their 18th birthday to start investing their money because it's going to pay dividends quite literally through their entire lifetime. However, as much as I encourage people to invest at a young age, there is still a point in life where it's too early to invest, and that's when you have really high debt. So if you've got high interest loans, high interest credit cards or any other financial products where you owe money that you're repaying every single month, look at the interest rate first, because if it's anything above, I'd say 6 to 7%, consider paying all of that off first and getting rid of those debts. If it's low interest and you're paying 1 to 2%, keep it because that's actually quite a good financial product. And in this, your mortgage is excluded. So I'm talking purely about payday loans, Klarna, credit cards, overdraft, anything that's very expensive on a monthly basis. Pay it off, get rid of those debts. In the stock market and index funds, you can typically make about 10 to 15% on average every single year if you're invested into medium to high risk funds. But if the interest is more than that, then that means that that's costing you more money. Therefore, you should pay it off first. This is all about assessing all of the interest products you have and working out where's your money best spent, paying off the interest on the debt product or putting it into the stock market where it can get 10 to 15% a year. Also, you should have some emergency money stashed away in cash that you can quickly and easily access. The going rule of thumb is about 6 to 12 months. It depends where you are in life. If you've got a family and a car and a mortgage, I would recommend a minimum of 6 to 12 months. If you're in your early 20s and you don't have that many commitments, then you can probably bump that down to about 3 months contingency at the absolute max, just so you can afford rent if you lost your job tomorrow. So have that cash pile available first as well before you start putting loads of money into the stock market. Secondly is setting unrealistic expectations. But before we jump into point number 2, hit subscribe below on the channel. We're growing this awesome community of finance people here on YouTube, and it really helps out a small channel, and you'll get loads of other great content on my channel suggested right to your home feed, so click subscribe below. So, unrealistic expectations. Now, building wealth in the stock market can take a really long time. It's all about the long game. So don't expect to put your money in today and get 10% gains tomorrow. It happens over the course of a year. And of course, index funds can go up as well as down. So you might see that you invest your money and you might lose 1 to 2% in the first week because the stock market's a little bit volatile and you've invested your money into a more volatile fund, but you shouldn't be afraid of this. Any money that you do invest into the stock market, ideally you shouldn't need to use it for the next 3 to 5 years at an absolute minimum. That will give the stock market time to ride out any potential dips. You could be investing your money this year and there could be a huge crash and we just don't know it yet. That could happen, but as we've seen in the long run, since the S&P 500, which is the top 500 US companies, was set up in 1923, over the course of time and history, it's gone up at around 10% every single year. Some years have done really well at 20+%, some years have done really bad at -20%, but that's the average trend, which is why you need to look at this from a long-term perspective. Many wealthy people like Warren Buffett aren't as rich as they are because they timed the market really well or bought a particular stock. Warren Buffett is so incredibly wealthy is because he spent so much time in the stock market and he invested from the earliest age possible, so he's just had the benefit of spending 70 to 80 years in the stock market. Now that's incredible compounded growth. The other extreme is putting your money into an average or low risk fund because you're a little bit scared of losing money, but then expecting it to have massive gains over the years. A low to medium risk fund might only gain about 1 to 5% a year at max. Thirdly is putting all of your eggs into one basket. Now, the number 1 key piece of advice you should always remember with investing is not to put all of your cash into one single stock or share. Now, I did a different video about how I put all of my money into Bitcoin and almost lost absolutely everything. It's a really silly thing to do. The great thing with Vanguard and Fidelity and loads of other platforms that when you're investing into an index fund, you are spreading your money across hundreds of different companies. Now, a really good thing to do is head onto these platforms, search all of the funds and choose one based on your own risk rating, as well as looking at the portfolios, what companies are in them, what are the top 10, how has it performed over the past few years, and really thinking about where you want to put your money. I predominantly put my money in a lot of the American tech stocks, so the Amazons, Googles, Facebooks of the world. They've been doing really well over the past few years, and I think there is huge potential in these companies. If you want to reach the ultimate level of investing, you need to be diversifying your own funds and money by spreading it as thinly as possible to mitigate against any particular drops. Now, I tend to invest about 75% of my money into index funds in the S&P 500 and NASDAQ, which is where those American tech companies are. But I also invest the other 25% of my money in other global markets. So if the US market takes a hit, then in Japan or Asia, things aren't as volatile and my whole portfolio over there stays somewhat stable. And it's the same for the UK as well. Even though all the global markets are somewhat linked, it offers some protection by diversifying it not only in one index fund across many companies, but also different parts of the world. So as one economy has an issue or potential crash, the other ones are still doing reasonably okay. Fourth is using past performance as an indicator of future performance. Now, you might have heard the famous phrase before that past performance isn't an indicator of future performance, and it's really true. Now, the worst thing you could do is go into Vanguard, search all of the funds, and then look at the highest performing fund, which I can tell you is the S&P 500 or the American Equity Index Fund, and assume that it's going to get the same every single year. Don't get me wrong, it's a really good idea to research all of these funds and see which ones can be the highest performing, but it's not guaranteed. This year, you could put your money into the S&P 500 or the American tech stocks, and it could go down 15 to 20%. We just don't really know. Part of this is understanding the companies you're investing your money into. The reason why I invest into the American tech stocks is because I genuinely believe these companies are doing great things. They're innovating, they're pushing, they're changing technology. For example, with Amazon, you could just think that they're an online e-commerce company that sell things and they deliver them to you using Amazon Prime, but Amazon are working on till-less systems in stores that is going to be really innovative in the future and completely get rid of the need for tills, which is incredible technology. Apple are not only just making iPhones every single year, but they're now designing and building their own silicon chips that is scalable, and these CPUs are completely blitzing all of the performance of Intel and making Intel really good. And it's this kind of innovation that you want to be putting your money into, because that's where profits will be made and ultimately the performance gains in your index portfolio. Fifth is not making use of the index funds. Now, on Vanguard, when you sign up to the platform, you'll see that there are loads of different funds. There are equities, there are bonds, and there are blended funds. And the difference between the three, the equities are shares in actual companies through index funds, and an index fund being a big central fund that invests money across hundreds of companies rather than one individual company. So a great way to invest your money. Bonds are essentially government loans, which are seen as low risk and safer, but also have lower returns at the same time. But don't be afraid to invest some of your money into some of the higher and medium risk index funds, because that's where the higher gains can be made. And over the long term, that's what we're investing for, you can really start to see some good gains. Even if there's a market dip today, you could still see a decent increase over the next 5 years. A lot of people, when they're investing for the first time, just stick it in something really low, purely out of fear. They might get 2 to 3%, but that again is below inflation, so the value of your money is still less compared to the cost of living. If you're a little bit unsure of how and where to invest your money, then Vanguard have these awesome funds called Life Strategy. Now, the Life Strategy funds go from 20, 40, 60, 80 or 100, and it's a different weighted allocation, and it determines how much goes into bonds versus into the equities and all of the stocks. So the more riskier the fund is, the more it invests into all of the equities, but it's a mixture of bonds keeping it safe, whereas when you get to 100%, that means that all of it is invested into stocks and shares. Now, I'm a huge fan. I don't personally invest into bonds because I think they're a little bit too slow in terms of the performance for me, but it's purely up to you and your appetite. 6 is not keeping up with your investments. Now, unlike a savings account where you can just dump your money in there, leave it and look at it in a few years' time where it hasn't really grown very much, but you know it's there and it's safe. With investments, it is good practice just to keep an eye on it. Now, if you're investing into index funds, they're a really easy and simple way, and you could just dump your money in there and leave it and look at it in 5 years' time, and I'm sure there would be some degree of an increase, but it is good practice just to see what's going on. If you see a dip, I do not recommend trading it, selling it, and rebuying into different funds. Just hold your ground and keep your money invested in that particular fund, especially if it's in a strong market invested into really good companies. But for example, if you're investing your money into bonds because you don't want to invest all of it into the higher risk funds, but then your risk appetite changes and you become more comfortable with what you're investing in, you could then look at selling some of those bonds when they've made a bit of a profit and investing more into the stock market. So you can start to reweight and change things over time as long as you're not selling it at a loss. And that's why it's healthy just to keep a nice eye on things and know where the portfolio is at any one time, because it can move up and down. So you'll be aware if there's a dip in the market versus a surge, and you'll have a good idea of what your money could be worth over time and help you to plan your money forwards. So now you've learned about the top typical mistakes that beginners make when investing into Vanguard and other different platforms. Check out this video here, which shows how I've grown my money from £0 to £122,000 by investing in my stocks and shares ISA across Vanguard and Fidelity. So it'll really help you understand where and how to find awesome funds, and talks about life strategies, bonds, and also all of the equities on the platform. So check this video out here, and I will see you in the next video.